Hey everyone, welcome back to the REI Marketing Secrets Podcast. Today on the show, we have Megan Young. And Megan, for our audience out there who's learning about yourself for the very first time, do you mind just going over a little bit about your real estate background and how you got started?
Yeah, absolutely. So I got started pretty much how I think a lot of people start, which is kind of not wanting to do my typical 9 to 5 job anymore. I was in sales and I was doing business to business sales. I was selling eyewear to doctors, and I knew I just didn't want to necessarily have a boss forever. So I started to kind of I don't know, ask around, and somehow I don't even remember who referred me, but I somehow read the book Rich Dad Poor Dad, which I think so many investors have started out that way, so it's very cliche. But nonetheless, that did change my mindset, and it just totally changed my life as far as I knew that I wanted to be an investor. I knew I wanted to get out of the employee box and get into the investor box. So from there, I started listening to Bigger Pockets. That was like pretty much my Bible for the next year that I listened to as I drove for, 5 hours a day doing outside sales. And I kind of learned everything about as much as I could. And then from there, I luckily decided to make a move. And so the first purchase that I made was a fourplex in Cleveland. And I chose that market because it was a low barrier to entry. I was able to buy a fourplex for 140,000, so it wasn't going to break the bank. I was able to finance it for a really good loan amount. And I actually still have that fourplex to this day. It is cash flowing like absolutely crazy. I have like a $600 mortgage and I make $3,000 on it. So it was a really awesome first investment, which also made me want to invest more. So from there, I continued to do small multifamily. And after that, I just decided I really wanted to scale even bigger. So I started Googling how to buy larger apartments. And from there, I got into real estate syndication, which started in multifamily apartments. So I went to a conference, and from there, I learned a lot about that. At the end of the conference, just like most of these real estate conferences, they sell you their mastermind. I, of course, purchased it, even though I was like very underqualified to purchase it. I did. And so I invested $25,000, which was steep at the time, to basically have 3 weeks with these other top investors that luckily were huge syndicators, owned thousands of units. And so I was able to really learn the most I could possibly learn in that year and really build really strong relationships with very cool, awesome, experienced operators. And after that, I, of course, invested passively because I wanted to know what it was to be an LP and go through that process. So I chose my favorite sponsor and I invested in one of their deals in Tennessee, which I'm still currently in. And after that, I decided, okay, I'm ready to be part of the team and join co-GP. And right after that happened, it was kind of when the interest rates like started to double
Hmm.
like overnight. And unfortunately, a lot of multifamily deals didn't quite pencil out as well. So the returns weren't as great and they're a bit harder to, I don't want to say sell, but present to investors where it really was like appealing for them to put their money in for 5 years. So through that, I just started to really pivot and try to look for other asset classes in real estate that would provide better returns. And I came across assisted living facilities for seniors. And I was introduced to an awesome group through another investor that I really liked and admired. And so I joined that team and I started to help them find investors. And I also invested in that as well because I always invest along with my investors. And I just have been sold ever since because the returns are amazing. It's such a safe, awesome asset class. And so now I'm definitely a fan and I'll continue to invest in that asset class. And I'm starting to learn about some more as well, but assisted living is definitely one that I favor right now.
Yeah, I like that story. It really started from the beginning in that fourplex and then gradually making your way up through and then obviously the assisted living. Right now, are you doing anything in the multifamily space or is it more just looking at that assisted living space just given everything that's sort of gone on in the multifamily space where if it's the same amount of work to go out and get these assisted living facilities, but you're making more bang for your buck, does it more make more sense for you to go in that direction? Just curious what,
Yeah.
whether you're just focusing on the assisted living or if you're, still dabbling a little bit into the multifamily space.
Yeah. So, for my day job, I am a commercial real estate agent. So I see a lot of deals. So I do have different partners that we still will buy multifamily, but they're definitely a niche, and we do them as joint ventures. So they're a bit smaller deals, and they just really make sense for us. And so we do some stuff with like affordable housing, LIHTC, Section 8. So it depends. But from a limited partner standpoint, as far as if I were a passive investor, I would never have my passive investor invest in most multifamily deals with the returns that most of them give at the moment. Just like because ALF, assisted living facilities, provide such a higher return, and they also provide the cash on cash right up front. So the most unique thing about assisted living facilities is that they're a business and real estate. So you're not just investing into the real estate, you are still getting all of the benefits that real estate provides as far as, your bonus depreciation that you're getting for your tax benefits, the forced depreciation of the asset when you sell it. But you're also buying a business. So when we acquire these, we acquire them pretty much stabilized. So we're able to give investors their cash on cash preferred return between a 7 and 8% quarter one after we close. And that's like pretty unheard of. So as a cash investor, which I am, this was huge for me because I want that cash flow up front. I don't want to wait 5 years to get my money back for them to double my money in 5 years, because I want that cash on cash throughout the entire investment period, because then I can take that money and I can go invest in other things like an oil and gas fund or a private equity fund that's a shorter term, right? So I think the goal is really like diversification. And I like to really work with investors and figure out kind of what their goals are, how much money they have to invest with. And then I sort of help them place their money in different asset classes that like make sense, that can just give them the most yield in the amount of time that makes sense for them.
Yeah, and like where you mentioned getting that 7 to 8% Q1, after you invest. I know I've been in a multifamily deal for, gosh, almost 2 years now. I'm just getting
Yeah.
5% monthly, and it's like it's fine. I mean, I'm happy I'm getting something where the distributions haven't been paused and there hasn't been a capital call. But I'm like,
Right.
I'd much
which
rather
is
be getting seven
actually
to
which
eight.
is actually pretty lucky these days, because I have like
Yeah,
so many friends that, when it was great and everyone was investing in it, but then obviously, the operators that got in trouble for doing a little bit too high LTV and basing all their projections on these crazy rent increases, and then now their bridge debt's coming to fruition, and they have to either extend the sale or they have to do a capital call, and they haven't got any cash distributions, and they'll be lucky if they get their money out. So it's I mean, it has become like a little bit scarier environment for a limited partner, and I think because it was just all fun and games before that happened, and now when I talk to investors, they're a lot more inquisitive of what's the exit strategy, what if this happens, what if this happens, because I think before people didn't ask questions, they were like, oh, everything's great, like you can't lose, you know what I mean?
yeah, exactly. Like, I don't know how much I looked before. Like, I mean, I'd look at the numbers, but I don't know how much I was fixed on like what the financing was, whether it was a fixed rate, variable
Yeah.
rate. We're now
Yeah.
like, I'm
No, you
definitely
just look
checking
at
it
the
out.
returns. You just look at the returns as an investor, and you're like, great, you're giving me these returns, perfect. But like, what happens if that doesn't work out? And I also think it's important to invest with sponsors that have like a larger portfolio to fall back on, because
Mhm.
there's some syndicators I work with that they got into the same trouble, but because they had a larger portfolio, they were able to start a debt fund. They were able to cross collateralize and still able to give the investors back their money, right? So if you're investing with someone that like that's their only deal and that's what all your money's in, like a little riskier. So
Yeah, I would say that as well, where investing with someone for the very first time could definitely be could definitely be a little risky. I know for me, I invested in a triple net lease fund, which definitely different than
yeah,
multifamily, and I think they've
yeah,
only done a handful of deals, but that one's been good from a communication standpoint where I get to access them right away. But sometimes I'm
yeah,
like, if I was doing a more aggressive play like a multifamily heavy value add deal, are they going to know how to manage the property? Are they going to have the right property management team? in place
Yep.
where that triple net lease, I mean, at the end of the day, it's a commercial corporate grade A tenants. I mean, it's AutoZone, Dollar General. I feel pretty
Yeah.
confident that
Right.
it has the built-in rent increases. It'd be pretty hard for me to lose money on the deal. I mean, it would be the tenant leaving and we just never find another tenant. That's
Right.
worst case
I mean, and
scenario
there's
where
risk. There is risk in every investment. Let's be real. There's risk in the stock market, which everyone has their entire 401k in, and that could collapse any second. So it's like, I think every investor knows there's going to be an element of risk. It's just mitigating that risk and diversifying, right? Like, don't be an investor that, like, which I know a lot of them, like, their entire portfolio is in multifamily and they're all in Texas. I'm like, seriously? Like, like I don't get it, but that's just me. Like I would rather like if I'm in multifamily, like I'm gonna choose some different markets and I'm gonna choose, different asset classes within real estate. And then I'm also gonna choose some private equity stuff because it's a little bit shorter term, a little bit higher returns, a little bit riskier, but like if you again research and do the right operators, then you're fine. And I feel like with the fact that I am like a huge networker, I go to like 10 conferences a year. I'm in a lot of masterminds. My goal is to really get to know people on like a personal level. The sponsors that I work with and the teams that I'm on, I know them really well, and I know their values and morals, and that the most important thing for them is returning capital to investors because that's how they all stay in business. And so I feel strongly about the people that I work with and I vet, so I'm comfortable enough to help my investors invest with those sponsors. And I also invest with them and I invest my family with them. So like if I'm investing myself and my family and I'm like, I'm all on board with them. So I feel like that's important too. There's a million people that raise capital. It's kind of insane on LinkedIn. I'm like, oh my God, like, is this everyone's like job now? What is going on? It just got like so trendy almost that it's kind of like hard to choose in a way. So I would just say investors really need to, like and trust the person that they're talking to as far as like, the that's introducing them to the sponsorship team that they're a co-GP on. But I would also say to like do your due diligence, look at the track record of the sponsors, make sure that they're investing as well in it. Because if they're not, then they're not as invested. So why would you invest your money too? You know what I mean? So I just feel like I'm very strict on how I invest and I give the same standards, or I mean, I would expect them to have the same standards for themselves, just to like avoid anything. Because it's like your reputation too. So if I tell an investor to invest in something and it fails, that's my reputation, like, which is huge to me. That's all you have, right?
Yeah, I can't agree more with that. And I like where you mentioned the part of just like vetting the sponsor, checking them out, seeing how everything's going. Because at the end of the day, where can the stock market, I could go buy a stock and I could sell it tomorrow and get my capital back as long as it didn't go down to zero. Or real estate, it's more of your a liquid investment where you're putting in that 50, 100K and it could be in there for 5 to 7 years. So if something,
Yeah,
if the deal goes wrong, you want to make sure that this person can take care of it, that they can do a good job with that. But with that said, are there any like red flags that you look out for when you're talking to these different sponsors? Like one for me,
yeah.
as an example, is like how they
Right.
communicate. Like if I
Oh yeah.
ask
Hmm.
them a question based on their underwriting and they take 2 weeks to get back to me, well, I'm
Oh
like,
yeah. Yeah.
well, I'm not
No.
going to invest my money with you if I haven't even
No.
invested cash with you and you're taking
Yeah.
forever to get back to me, or if I just feel like their IR person isn't knowledgeable, even though the
Yeah.
person running the company is. So that's the
Yeah.
person that they're presenting out to me. So there's different red flags that I look for and sponsors on my end, but I'm curious if there's anything that you've picked up over the years where you're like, maybe I'm not going to have any of my clients or any of my, people investing money with this particular sponsor just based on, what I'm feeling about them.
For sure. No, there's a lot for me. Because like I said, I'm just like super strict and crazy. So number one, I have to like know them personally. Like I have to like
Mm.
actually have, seen the properties, gone out to the properties, know how they work. They have to communicate really well. And the emails that go out to the investors have to actually be like knowledgeable and basically, state everything, like no hiding anything. So the team I work with, they're amazing. They essentially will go through every single thing that went on. Assisted living is a little different than a lot of other investments. So, like last month, we had 12 people that died. Like, that was just what happened. Like, it was super random, very high, doesn't usually happen, but like 12 people passed away. And that's like just what happens in assisted living. So they're like, okay, it's okay. We have a wait list, so we're going to be able to fill these up pretty quickly. But nonetheless, like they need to say the good, the bad, the ugly, not just like everything's going great, bye. So I feel
Mhm.
like just like detailed analysis, like what were the projections for this month? Where are we at? What was the total NOI? Do we have any capex? Like what exactly is going on, right? Just super detailed. And then for me, I like I said, I do like the track record. I want them to have some experience. I want them to have a portfolio that they can fall back on. I don't want them just to own one property and this is their first syndication. Like I'm not. I don't want to be there for your mistakes. Like
Mhm.
I'll just go with people that know what they're doing. And then people that are just expanding and growing that they can show that, hey, the last investment we did, these were our projections and we're way ahead. I would much rather have someone under promise and over deliver all day long than give these crazy projections and then they don't meet them like at all. Then it's like, then the investor is disappointed from the start and you're not winning anyone over for the future. So the last assisted living facility that I did with this group, they're called Arrows Capital, we're like way ahead of projections. And all the investors are so happy. This was a year ago. So we're scaling and growing because we're doing so well. So we're under contract for 2 more facilities to essentially grow from the first one because they're 20 minutes apart. And we already have all the operations and management and everything ready to go. And so I'm having a lot of repeat investors because they're like, this is amazing. I invested $100,000 and I'm making $800 a month. Like, that's
Mhm.
amazing. And that is just the start. And they continue to increase. So the cash on cash over the 5-year term will still be 10 to 14% on average. So, I mean, those are incredible returns. The investors are very happy. And when investors are happy, they want to not only refer you people, but they want to repeat invest. So it just makes your life easier as well. And you get a good reputation from it. So that's who I choose. If I was going to do multifamily again, from a standpoint of joining a co-GP, I would probably only choose people that are vertically integrated, meaning they
Mhm.
have their own management, they have their own construction team, so they're still able to get pretty decent returns. And I know a few that still provide a pref equity, which for me, I have to have a pref equity. I want my cash on cash return throughout the investment. I'm not waiting 5 years for me. Now, if I was investing with a self-directed IRA or a 401k, that doesn't matter because you're getting the money later anyways. So those type of investors, they don't necessarily need the pref return, right? But my cash investors do. So that's another set metric that I would say if someone's doing it on a 401k or IRA, then you're just looking for essentially the equity multiple and the IRR, right? Because you're just like, how much upside can I have in 5 years? So, and that's kind of different looking at them too. But I still feel like assisted living facilities have the highest returns, during the investment and on the upside. So they still kind of win. But some multifamily, you never know. You can't say all the deals are different. So I would never say I wouldn't. It would just every deal's different. So I'd have to look at it.
Yeah, most certainly. And curious about like the assisted living, like what's the sort of strategy there? And I'm thinking like like multifamily, you come in and it's just like
Yeah.
more of like a value add. When it comes to like assisted living, is it more ground up development? Is it more just taking over operations that maybe they just haven't been doing a good job? I think of like self storage facilities. There's so many mom and pop owners where they haven't raised rents, where I would imagine they haven't raised. I don't know the exact terminology in senior living, but
Yeah,
say
yeah.
the room rates,
No,
they haven't
it's
increased those. But curious, like what that
yeah.
strategy is there.
Yeah, I mean it's kind of similar except for like think of it more as like if you were a private equity company and you were going in to acquire a business, typically they would acquire it based on their knowing that they can increase operations, marketing, etc., to increase profits. So the same exact thing with assisted living facilities. So we typically will still target the mom and pops, and most of them are struggling because they don't know how to market properly. They don't know how to get more private pay people in there, which pay more. They don't know how to get the right referrals from the hospitals and other ways that we work with the insurance pay or public pay. And they also, some of them are still like doing charts on pen and paper. So we would be able to go in and digitize everything and create just more efficiencies throughout the whole facility to increase the NOI. So there's a lot of management and operation stuff. Usually it's not a ton of like physical value add because the cool thing about assisted living facilities is like they don't want the brand new stuff. Like they're a baby boomer generation. Like they like the
Hmm.
old wood. They like the antique stuff. So they actually like don't like the modern stuff. It doesn't make them feel as comfortable. So I thought that was like super interesting when I was touring the facilities. I'm like, oh, like we got carpet and like this like old wood and like it's all nice and clean, but it's old. It's like super old. And they're like, nope, they like this. They feel they get anxiety with like too new, too modern. And so we like to keep it how they're comfortable and how they, grew up. And I'm like, that's just so interesting. But it made a lot of sense. And it's also great from an investor standpoint that you're not having to go in and get granite countertops and upgrade all everything. Like, nope, it just stays. It's like you just keep it classic, and that's what they like.
Yeah, it's honestly what I thought in my mind is is going in there and upgrading the units similar to like what you do for a
Yeah,
multifamily deal.
not
But
at
I mean,
all.
that
It's
that
funny.
seems to make sense though that they would want to go like old school and keep it the way that it is. When it does come to like these assisted living facilities, is there like certain markets you choose, whether like certain states? How do you go about like finding or is it more like across the entire US? Just curious like what that sort of strategy looks like.
Yeah, no. So the team that I work with, we only focus on East Wisconsin area, so like near Green Bay, and all the facilities that we have are within 3 hours, and that's all that we'll be acquiring, just so that we can use the same management, employees, et cetera, and just kind of expand. And we're really growing a brand there, so that we can just extend that brand and continue to get more residents based on how awesome the brand is, and that people know it and they want to send their parents there because they know it's an A-class facility with 5-star reviews. We really put a lot of pride in the nurses and employees that we have. We typically will pay higher to retain them. That's one of the biggest problems in a lot of these assisted living facilities is the employees and the staff, and trying to get qualified, nice people that will stay and treat the residents well. So that's one thing that we really like focus on, is having our employees that are really well trained, that want to be there, that are that they're happy to be there and they're being well paid and they have great benefits. And so that part is also very important. And we also self manage. So we're not dealing with a third party management that's just like hiring these temps to go in that, do crazy things. So that's another thing to look for is third party management in assisted livings can be, I mean, just like with everything, can be a little sketchy because at the end of the day, that management company, like they're another number. They're not going to care about your property like you would. So that's why I like the vertically integrated sponsors, because it's like they are managing it, they are overseeing it, so they're going to have like a lot more care and it's going to go a lot smoother, so the investment's going to be a lot more stable and safe.
Is there like a certain hold period that you have when you're going out and buying these properties? Is it like, 5 to 7 years? And then with that, like, is there a certain time frame where I don't know if it's like a refinance or when someone could expect like a return of principal or get some sort of return of principal back above and beyond, say, the 8% that they're getting in a single month? Is it more at the end of the sale? Is it halfway through? Just curious. I would imagine it's probably more deal by deal basis, but what's the I guess the
Yeah,
sort of average
every
metric?
deal is different. However, most are going to be structured, and projections and performance are going to be done on a 5-year term. With assistant living facilities, it's a little bit different with the debt. So we do a transition bridge loan into a HUD. So the first year we are paying that higher percent of a bridge loan because it's short term and it's interest only. However, we work with lenders that are very specific into transitioning that loan into a HUD product, which is another reason why I love this sector, is because we get to go into a HUD at usually like 6.5%, and it's for like a fixed 30 years or 35 years or something crazy. So then the returns are obviously going to go up. So for the first year, it's usually going to be that pref return. And then, once we approach year 2, year 3, those returns are going to continue to go up. And, like I said, it's the last one, it was 10 to 14% cash on cash throughout the investment. But that was just very conservatively underwritten. So those numbers can go up. And then obviously upon sale is when the bulk is given with, the forced appreciation and everything else from holding it that long.
Yeah, no, it sounds like a really nice investment.
Yeah,
But let's say,
that's what I mean. Like you can't beat them. That's what's so hard. I mean, unless you're doing like private equity, which I'm starting to get into too, because private equity, I mean, you can get like 16 to 30% returns, and
mhm.
they're absolutely incredible. So again, it's like I really like to find the best sponsors and people that own these private equity funds that I trust. That I put my money in first. I test them. I see how they communicate. I find out their background, their track record, like how many companies that they have worked with and flipped, and what their fund looks like, and their returns. And then after that is when I'll put it into, something that I'll put my investors into. So I always vet everything first, but I'm definitely getting into the private equity sector. Gas and oil is another one that are awesome just to do alongside with these real estate ones because they're a little bit higher returns, like even more so. But if I'm doing just like strictly real estate, then usually I'll choose the assisted living
Yeah, like that.
for
Like you
passive.
mentioned,
And
like
I'm
yeah,
talking passive. For active, I'm like, every deal is different. Like every single deal is different. I'll do any deal if it makes sense, right? But I'm saying for passive investors, I haven't found a multifamily that can beat my assisted living returns.
yeah, and I would agree with that. Like even like when I'm investing in like the triple net lease, like I'm getting like 8% of the money there, but there's not a ton of appreciation on the upside. It's more just it's pretty similar. There's not going to be a lot of appreciation on the deal where it's like the nice cash flow, but where it sounds like the assisted living, you're going to get a better once you go out and sell the property a few years down the line. Like with my triple net lease, probably hypothetically would probably double my money over 7 to 8 years, which is fine. That's I know it's a lot safer of an investment, but it sounds like the assisted living, you might get that 2x equity over 5 or 6 years, or maybe even sooner,
Yeah,
depending on how
maybe
how the
sooner.
deal flows
Yeah,
out.
like if we get an offer that makes sense year 3 or 4, then we'll sell, and it'll still most likely be like a 2.3 equity multiple, like at a minimum.
Yeah, that's phenomenal. Like you mentioned, getting that 7 to 8% in the beginning, in the first couple of months that you're in the deal, and then obviously it can go up from there over time. I just really like the asset class, and I think not. It's almost like I don't think too many people have sort of like looked into it as much. It's almost like everyone's in multifamily. You're here,
Oh yeah,
it's like 90% of the people I talk to, I feel like, are in multifamily, where it's like you have these other almost like gold mines of asset classes outside of
yeah,
multifamily that people haven't really explored. I think it's just people understand. I feel like multifamily, just from the standpoint it's apartments, where they
yeah.
may not know as much about the assisted living, where it presents like a really good opportunity.
For sure. And like not only that, we didn't even talk about the demand factor in ALFs, which is like also crazy. There's actually going to be like a shortage of them. So I have like a couple stats because I always forget them. But essentially, 1 in 4 Americans over 65 will be going into an ALF by 2040. So we're going to be short 1 million units by 2040 for seniors. So there's like this huge demand for it. 10,000 baby boomers retire daily by 2030. So, I mean, it's really like the biggest need also
Hmm.
for housing. So, with that, when there's obviously, just normal supply and demand, if there's a higher demand, then guess what happens? The rent goes up because there's not enough of them. So, the industry in senior living, so not just assisted living, but like independent, senior living, assisted living, memory care, and also nursing, that the industry total is $96.6 billion right now. By 2030, it's going to be 140.8 billion.
Oh wow.
That's crazy. So those are like also like the statistics to like back up the demand of them. Like that makes it more stable for me as well. I mean, and multifamily, like you definitely have your markets that you're going to need, like it's always going to be a renter's market because there's not affordable housing there, and I totally get it. But there's still like way more multifamily than there is assisted living, and the biggest generation that we're going to have in the next 10 years is baby boomers. So it's kind of nice to invest in that, right? Be ahead of it.
Yeah, exactly. And let's say someone's like listening to the show today and they're like, wow, like this really sounds good. Like I want to chat with Megan. I want to invest with their company. What does that like communications from a communication standpoint look like after someone has invested with you and just keeping them up to date on all the updates that are going on with their investment?
Yeah, absolutely. So firstly, like I'm like a very like face to face person. I want to like get to know my investors. I want to have a relationship with them. Like, so I typically will set up an investment call, figure out what their goals are, figure out everything they're looking for, and then at that point, I'll fit them with the best investment for them. And then after that, I give them my cell phone number, like whatever they need. And then every quarter we have those emails that go out that will be very detailed about the investment. But yeah, I keep a very like open door policy, email, text, whatever. I'm very personal with my investors, and I'll say I have very good relationships with them.
Yeah, that's awesome. And really, the last question of the day I have is if someone is interested in working with you and learning more about you and your company, where should they go to?
I'll say I'm pretty much on LinkedIn for the most part. So I can give you my link for LinkedIn. But my company's called Nova Sky Capital. I named it after my daughter because I'm definitely like a family oriented person, and I'm very my goal and reason for doing this is to really have the freedom to be with my family more, to have generational wealth, and to help other people have the same. So, that's where my values lie, and I can be found on there and pretty much everything. As far as they can go there and download my free ebook, which is on how to invest in assisted living as a passive investor. And that really gives like a very detailed outline of everything about the industry, the statistics, why to invest in it, how they work, how they make money. So they can go on LinkedIn and download that on the front of my page. And I can also give you the link for it too, that they can just click and download it.
Yeah, that's perfect. I'll make sure to include that in the show notes of today's episode. And Megan, thanks so much for coming on to the show today.
Yeah, thank you so much for having me.